Welcome to Capital Thinking, Energy Insights for Today's Market, presented by Stevens and Oil and Gas Investor Magazine. Today's topic is the 2024 outlook for upstream acquisitions and divestitures. We'll cover how the A&D landscape evolved during 2023, private equity activity, financing considerations, new opportunities, and competitive dynamics in the A&D market this year.
Welcome to Capital Thinking, Energy Insights for Today's Market. This virtual thought leadership webinar series explores the challenges and opportunities affecting the energy industry. This 2024 outlook for upstream acquisitions and divestitures has an industry-leading group of panelists. We have Brad Nelson, Managing Director and Head of Acquisitions and Divestitures in Stevens Energy Investment Banking Group, Clay Rynd, Executive Vice President of Crescent Energy and a Managing Director at KKR, Chris Conoscenti, CEO of Sitio Royalties, and Nick O'Grady, CEO at Northern Oil and Gas. I'm Jordan Blum, Editorial Director for Hart Energy and Oil and Gas Investor Magazine. Now, before we get into the questions, I'd like to give the panelists just a minute to briefly cover their backgrounds and what their firms are focused on at a high level. Chris, would you like to start?
Thanks, Jordan, and thanks to you and Brad for putting this together. So Sitio Royalties is one of the largest owners of oil and gas, mineral, and royalties in the country. And we focus primarily in the Permian Basin, but we also have assets in the DJ Basin, the Eagle Ford, and the Williston Basin. And publicly traded, we were started by a private equity firm out of New York called Kimmeridge, and we came public in 2022. Our business is really focused on three things. We're here to consolidate this highly fragmented mineral industry. Second, we're here to professionally manage those minerals once we own them, because we have found that active management of minerals creates a lot more value than just passively cashing checks. And the third thing we're here to do is to innovate around the skill sets that we have from owning minerals and underwriting acquisitions to really disrupt the relationship between operator and mineral owner, which is nowhere near how you would design it if you were to start from scratch today. So we're hoping to make some positive change there. So as we sit here today, about 250,000 net royalty acres in the third quarter last year, which is the most recent reported quarter for us. We had over 36,000 barrels of oil a day of production equivalent. And we have ownership interest in over 22,000 wells. So our business is a massive data exercise on the management side, and it's a large-scale consolidation strategy on the acquisition side.
And Nick?
Nick O'Grady, CEO of Northern. Thanks for having me as well. My story might sound very similar to Chris's, just a slightly different business model. NOG is the largest public non-operator. Similar yet different to mineral interests, we are a passive owner of working interests, meaning we own minority interests in oil and gas properties. We don't operate, but we own a pro rata interest in wells that are being developed. We have about 300,000 net acres. We're in three major basins: the Williston, the Permian, and in Appalachia. We have about 100 operators. We produce about 115,000 barrels of oil equivalent per day. We are the largest of our kind by a multitude. And over the last 6 years, we've acquired about $4 billion worth of properties. We were once a pretty small company. And we've pretty astutely grown the business over time. And similar to Chris's story, we believe a sort of data science and engineering driven approach has really changed the way this business has been done, which is really at one point just a land grab and buying small interests, and really been now driven by understanding the data and the science behind it, especially as shale has matured. It is still highly fragmented, and we believe there are multiples to be done yet to go.
Clay?
Yeah, hey, Clay Rynd with Crescent Energy. So Crescent is a publicly traded growth company focused on the energy sector. Currently today, we operate, develop, and acquire primarily operated working interest across the U.S. Similar to the other two, given this is an A&D panel, when we say it's a growth business, that growth is driven by our efforts on in the acquisition side of the business. So we have a kind of very stable portfolio of low decline assets. We really participate in what we consider kind of the mid to later stages of shale assets. And then also we have a large portfolio of conventional assets. So we have a stable base business, and the growth in our business comes through acquisition. Today, our business is focused in Texas, in the Rockies, and we produce around 160,000 barrels of oil equivalent per day. The business was built privately as part of KKR, started on a piece of paper and was built through acquisition over about a 10-year period. And we listed the business publicly through a reverse merger at the end of 2021, and have been going for a couple of years now as a publicly traded company.
And Brad.
Thanks, Jordan. And Chris, Clay, and Nick, thanks for joining us today as well. It's great to have you on this panel. As Jordan mentioned, I'm Brad Nelson. I'm a managing director in our energy investment banking group, and head up our A&D team. Quick background on Stephens and our energy platform. Stephens is in its 90th year as a family office. Started in the early 1930s, headquartered in Little Rock, Arkansas. We house our energy practice, if you will, in Dallas, and have been here for the last 15 years, growing our energy investment banking platform. A big focus of our investment banking group is A&D and M&A broadly. We feel like we've built out a deep technical bench over the last 4 or 5 years of technical talent, comprised of engineers and geologists. 23 was an active year for us. We closed approximately 20 transactions with an aggregate transaction value of around $3 billion. Have a lot of momentum and see that momentum carrying into 2024.
Thank you so much, everyone. Now let's start out by exploring how the A&D landscape has evolved during 2023 and where it may be headed this year. Brad, let's start with you. Overall, how active has Upstream A&D been this year compared with previous years? And what have been the major driving factors? Now, before we pass it to the other panelists, please provide a quick overview of how you think 2024 is setting up.
Sure. And look, I'll talk a little bit about 23 first, and then also reference 22 and calendar 21. You know, calendar 23, in terms of number of deals, aggregate transaction value, it was down a little bit, not drastically, but any way you look at it, it was probably down around 25% from calendar 22, 21. And, you know, the data that we receive, of course, is not the entire industry, but we think we capture a good bit of the announced transactions. And so, you know, just by way of putting some numbers to it, there were roughly 65, you know, deals announced in calendar 23, and those transactions are generally north of 10 million in value. So that was about the number of announced deals in 23. In 22 and 21, those figures were roughly 80 and 85 announced deals. So I would say, generally speaking, the numbers were a little bit light. Having said that, we had some major announcements, mega deals that were announced in Q4 and into Q1 of this year. You had the Chevron Hess deal, the Pioneer Exxon deal, Oxy Crown Quest, and of course, you know, Chesapeake and Southwestern announced earlier this year. So, you know, you're seeing a lot of mega deals happen all in a pretty short period of time, and from our perspective, in the last, call it, you know, 3-4 months. And we do think this is a bullish sign going into 24. You know, in our opinion, we feel that a lot of these bigger buyers and bigger mergers are more around people seeking high quality inventory, long-term inventory, which in our opinion is a very bullish sign for the industry. And so as we roll into 24, we think that, you know, these mega mergers will continue to have a positive, you know, ripple effect on the industry. You know, the mid cap guys and the private equity and other private types of capital, if you will, I do think to some extent look to see what the bigger players are doing and how they're kind of, viewing the economy and the world as they look forward and look for some leadership from that perspective. So we're, generally speaking, optimistic about activity in 24 based on what we've seen in the last 3 or 4 months.
Right. Now, Clay, how active, broadly speaking, have private equity firms been in A&D in the last year? And how do you see that changing in 2024? And please feel free to discuss your activity in the energy space through your role at Crescent.
Yeah, of course. So to start on the question on private equity broadly, so I think the short answer is incredibly active in the A&D market. But interestingly, I think it was on one side of the ledger. So private equity was involved in kind of 80% of A&D transactions in 23, but all of those as a seller. So and then they were only involved in less than 20% of the transactions in 23 as a buyer. So the previous kind of couple of years where you've seen private equity be active is as a seller of assets. That certainly occurred in a big way in the Permian Basin in particular last year, but was true broadly. And I think as you look into 24, certainly you have some large assets that are looking to be on the market or rumored to be. So I think that trend as private equity as a seller will continue. On the buy side, it is certainly less active on the private equity side there. And then where you have seen private equity be active, it's actually tended to be behind platforms that already exist and already have assets. So it's actually kind of continuing to build businesses as opposed to putting new businesses in place. And so you just have a meaningfully smaller amount of kind of new businesses being seeded by private equity. I think that creates an opportunity. I think that will continue. Certainly, don't count them out, and you will see more capital come to the space. But I do think the opportunity set is there that you do have that lack of buying activity on the private equity side. And then, from a Crescent perspective, as we survey the space, our business, as I noted, was built to be built through A&D. We see a large opportunity in the market. I think 24 has started volatile, as always. We think there's a real opportunity just around continued regular way consolidation in the market. There's still lots of assets held in non-long-term hands, and we think there's an opportunity for that. But also we think there's a real opportunity, as Brad noted, on this continuing wave of consolidation, in particular some of the larger companies that typically kind of follows into a cycle of those companies divesting assets as they get their hands around those assets. And we think, given our broad ability to play the market, both on conventional, and across a number of areas, we'll be well positioned to play there.
Very good. Nick, your firm was highly active in A&D throughout 2023. Please take us through some of your recent activity, any unique deal structures you are seeing arise given the current state of the market, and how you see non-operated groups potentially playing a more active role in A&D transactions throughout 2024. What differences do you see occurring this year versus 2023?
Yeah, I mean, I think broadly, 2023 for NOG was unique in that, we did 2 relatively large transactions in which we co-purchased operated assets with operators. We were minority owners of operated packages, and that's something we had not done before, at least not of a scale, that had been publicly announced as such. And we did it in a structured transaction. And so that obviously made some waves, and I expect, and I'll cover this in a bit, but I think that's something I would expect that you may or may not see from us in the future. But as it pertains to where I see it going forward, we have kind of what I would describe as multiple lines of business. What we refer to as our ground game, which is really on the ground, everything from buying fractional leasehold to adding to our fractional interest in our wellbores, just effectively all micro type acquisition activity that ebbs and flows. But given the volatility that we've seen in oil and gas prices, generally when things get ugly, that business can really pick up, because that tends to be where driven by capital intensity, and you're generally acquiring people's capital obligations, right? And so when people own oil and gas interests and they get capital calls on them and they don't want to pay or they can't afford to pay those capital calls, they're looking for a buyer who can take over those ownership interests, and that's where NOG can play a role. And so when things get ugly, you can derive a return out of that, and that's where our data set really plays a big role. And a lot of times, as a large working interest owner, we have a lot of that data already. I think the second thing that we talked a little bit about already is, you've seen these mega mergers arise, and I think that's going to create an opportunity for our company. With these big mergers that are going on, I think on the back end of that, there's going to be a lot of cleanup. One of the things that's not really fully understood is that 10 to 20% of every operated E&P company in this country's assets are non-operated. Most operators own large working interests that they never got around to, and we are a large purchaser of their non-operated interests on a regular basis. And so we expect and are having those types of conversations that, one of the next pieces of consolidation that we may play a role in is, potentially some, relatively large transactions where we can potentially help clean up some of those portfolios on the back end. And frankly, as the largest of our kind, these could be very large dollars that need to be solved for. So we fully expect to be part of those conversations. These are things that are going to take some time, but we very much hope to play a role in that. As I mentioned before, I think we've talked about we've both been a co-purchaser of assets. We have bought down interest in existing operated assets. We have done development joint ventures, and so I expect to see all forms of those developments come along over the next 6 to 12 months. But I think the main difference between 2023 and 2024 is I think you had a lot of assets owned by private equity that were well past their shelf life, that had needed to have been sold years before, and higher commodity prices over the last few years had allowed for them to be sold at prices that were relatively favorable. And I think you've seen a lot of those transact. There are still some, obviously, that still need to be sold, but I do think that number is dwindling, and so I think you will see less of that. But I don't think that necessarily will translate into less M&A as a whole, just because overall the oil and gas space remains as fragmented as ever, especially on the private side. And so I expect us to be about as busy this year as we were in the past. I think we've signed we're a month into the year, and I think we're a dozen NDAs into the year already.
And Chris, congrats on your firm's recent growth in the last few years. While 2021 and 2022 were very active M&A years for Sitio, it seems that you were less active, relatively speaking, this year. Please talk about some of the dynamics in the mineral and royalty space that played into that in 2023, and if you see this year playing out any differently.
Sure. I'll take a step back first and just explain why the consolidation is so important to the minerals business, unlike an E&P business. The economies of scale for minerals are unlike really any other business in the country. We get to leverage the existing base of people, really our costs, across a much larger asset base as we grow. So a good example of that is our cash G&A per BOE. In 2019, when we were a fraction of our size, our cash G&A per barrel was about $6, and we were about 40 or 50,000 net royalty acres. Here we are today, as I said, 250,000 net royalty acres, and our cash G&A per barrel is down near $2. So you've seen nothing but margin enhancement as we've gotten larger. So as we grow, if we enter a new region, we don't have to hire more completions engineers or drilling engineers or field people. We just don't have those functions at a minerals company. Really, all we do as we make acquisitions is we onboard more data. And so if we've built our systems properly and continue to innovate those systems as we grow, it's really not a tall task for the existing team, the existing cost base, to onboard new assets. And so it's a wonderful business model from that standpoint. The other thing that happens as we grow is we find that there are fewer and fewer competitors for large minerals assets. So if you were to say, here's an E&P asset, an operated E&P asset that's half $500 million, there's literally dozens of companies that could afford to write a check for that. But if you were to say, here's a minerals asset that's $500 million, there's maybe a handful of legitimate buyers, maybe 5. And so what we find for larger acquisitions is that there is less competition and therefore better returns for us on the larger side. So we like the benefits of scale from a profitability standpoint, from a competitive standpoint, and also for an investor relevance standpoint. So that's the backdrop for the consolidation. But to answer your question more directly, yeah, so we had some tremendous growth in 2021 and 2022 with multiple public company acquisitions, multiple private company acquisitions, some small deals as well. And as we entered into 2023, we were really optimistic, thinking we could continue that momentum. And what we found was several dynamics led to that being a lot more complicated in 2023. Not the least of which is I think we've spurred the competition from some of the other public minerals companies to pursue some larger scale M&A that they just haven't in recent years. So we saw some public minerals companies make some large acquisitions. We saw family offices looking for yield. We saw some private funds that were raised and needed to be put to work so they could earn their management fees. So there were all kinds of different motivations in 2023, but really what it led to was a really wide gap between the returns we could underwrite and what the market clearing price was, because there were these other competitors out there that became a lot more active in 2023. So as we sit here coming into 2024, I am seeing things improve. And the biggest sign of improvement for us is that things that are broadly auctioned, where there's a bank out there showing it to everybody that they can, we're seeing several of those fail. And to us, it's a very good sign. We don't participate in a lot of those, at least we're not successful in a lot of those. So when we see those processes fail, to us, it's a sign that there's a bit of market fatigue from other buyers, and makes us optimistic that there's going to be a realignment between what we can underwrite and what the market clearing price is. So we're looking forward to a much better year in 2024.
Very interesting. So Clay, what are your priorities for new opportunities? Is Crescent primarily focused on capturing new opportunities in specific basins, and does Crescent have a preference regarding oil versus gas? Do you see any more deals getting done in oil versus gas this year?
Yeah, so for us, the easiest place to start and the place where we have the most competitive advantages in and around our existing asset base. And so, in particular for us is we did $850 million worth of deals last year in the second half of last year in the Eagle Ford. We've been able to integrate those very well. We've built a pretty scaled operated Eagle Ford business, 250,000 net acres and over 60,000 BOE a day produced there. And so I think that's an obvious place. There's a ton of fragmentation in the Eagle Ford that I think you would expect us to continue to pursue. And importantly, as we built our business there, we can play across the various phase windows of the Eagle Ford. So we think there's a ton of opportunity for us there. We're active in the Rockies. We're very active in a conventional business that I mentioned. And just for reference, the conventional business is about a third of our existing production. And that's on a kind of stable 10-ish% decline production. So we think we're one of the most scaled players in the conventional market. And we think there's a real opportunity for us go forward around those assets. And so that is kind of, if you said, hey, where are you going to focus on a map? That's where we'd focus. But for us, we're investors at heart, and we're really driven by returns. And so we look at 150 to 200 deals a year at a minimum. We're really active, and it's really going to be where can we find places where we can buy cash flowing assets at attractive returns and have an opportunity to make 2+ times our money in the current commodity environment. And so, I mentioned our existing assets. That's where we start, but ultimately is where can we find returns, and we think there's a real opportunity for that. Gas versus oil, we have the benefit of being mixed. So the portfolio today is fairly mixed. We're about 60 to 65% liquids. That's oil and NGLs, and then the rest gas on a production basis. So we've got the opportunity to kind of look across. What I'd say is certainly, if you think the space trades on the forward curve, it's easier to buy a backwardation than contango. So oil is easier to underwrite and think about than gas. We've looked at big deals over the last few years. So I think we continue to be active across both. As you think about the broader market, though, certainly I think last year the vast majority of deals were in the oil market. I think we had the stats as almost 90% of the A&D deals were in the oil market, almost a complete lack of gas deals. You obviously, Brad mentioned at the start, you had one big gas deal that announced to start the year on the M&A side, but given the recent volatility in gas and some of the news around LNG, I certainly would expect gas to be slower, at least at the start of the year, than the oil markets.
Okay. Nick, looking from the buy side, how competitive is the non-op A&D market, and what criteria are most important when you're evaluating acquisitions? Are there certain areas of the market that are frothier than others, and do you see that changing this year?
Yeah, I mean, I think it's important to, some of Chris's comments kind of rang true for me. So I think it's important to give you a little context. If you believe the street estimates, we'll do well north of $1 billion in adjusted EBITDA this year. Something like $1.4 billion, I think, is the street estimate for us. We don't count our NGLs. We're what you call a two-stream reporter. So we're about just over 60% oil. Just so let's call it, somewhere around 70,000 barrels a day of oil. But we have about just under 40 employees. We were talking about, cost per barrel. That scale is really important, Jordan. So we, the largest department in our company by far is our technical staff. It's all mostly reservoir engineers and reservoir engineering technicians and data scientists. We spend millions on technology. We have a custom built Palantir system that we have about 10,000 wells, gross wells. We're 100 operators. We're in almost half of every Williston well ever drilled. So the data from an LOS perspective is invaluable. We have 400 plus type curves by area, by formation, by unit, by operator. And so you just can't match the data set. And in the Delaware Basin, we're getting to the point where the studies we have are just incredible. Sometimes I think we know more than the operators do, and you can use that asymmetry of information against them, frankly, sometimes. And so where I'm going with it is that, we have a competitor that's about 10,000 barrels a day that's also public, and they have more employees than we do. So our per unit per BOE cost is about 70 something cents per barrel last quarter. And so, which is one of the lowest in the industry. I think Diamondback might be the only public company, maybe beyond the majors, that I know that's lower than us. And maybe that just means we don't get paid enough as executives. I don't know. But regardless, the point being that when it comes to competition, we have a $1.6 billion revolver. We are a rated entity. We issued credit easily last year. We raised $290 million in a bought equity deal in 15 minutes last year. So from an access to capital perspective, for large transactions, we have no competition. So when you ask how competitive the market it is for large scale non-operated assets, to the extent that things are of large scale and size, we are the 800-pound gorilla, and we make no bones about it. But it is a tale of reservoir category, which is that for PDP-centric assets, which are mortgageable and you can borrow against, you can have competition because there are asset-backed securitizations. You can borrow money against anything that's mortgageable. And that's not a category that we're terribly interested in, because ultimately, when you buy a PDP asset, the only upside is ultimately well performance. So if you can actually underwrite better than somebody else, and commodity price. Whereas when you buy undeveloped assets, ultimately you have other levers to pull from a return perspective. And so we are focused more on undeveloped upside as it pertains to our assets, and that's where we really focus. So when it comes to competition on small scale, low concentration, and what I mean by low concentration, I mean low working interest. So things below $75 million in value and low working interest, and I mean by like less than 10% working interest asset, there can be a fair amount of competition from family offices and things like that. But oftentimes we have operators that call us who have upwards of 40 and 50% working interest in units that they do not have the budget to participate in. And these can be $80 million projects. So if that major just does not have the budget for that, even if those dollars are affordable by one of our competitors, the concentration of interest is not tenable, because in a $150 million private equity fund, $80 million in 8 wells is simply way too much concentration, whereas in our overall portfolio, that's very much manageable. So what I will be interested to see as it pertains to this year is, we have a fairly dour outlook in the short term for commodities. I think in the medium term, I think we're quite, I think I have a pretty good outlook for oil and over the next 4 to 5 years. But I think in the shorter term, I think we're a little bit more pessimistic, and we have seen a flurry of influx of capital over the last 12 to 18 months, particularly from family office money. And so for those Johnny come latelys, I'll be interested to see what happens over the next 12 to 18 months for that capital in the space, because we've seen, in my 6 years here, I've seen people come in and out of the space during periods of stronger pricing, and then for them only to run away when things have gotten ugly. Particularly, we saw that in 2020. I saw many faces show up in 2019, only never to be seen again. So it'll be interesting to see over this year if my personal prediction turns a little true.
We'll be watching. Brad, have you seen the emergence of any new buyers or sellers recently, and how do you see that evolving?
Sure, and there may be an emergency in there as well, but yeah, look, I'll mention a couple numbers and statistics first about 23. So as I mentioned earlier, the data that we're seeing and the information we're seeing on those transactions, again, it's roughly 60 deals in calendar 23. So call it 5 or 6 deals per month. On the buy side of those deals, the buyers were largely made up of, call it 50%, 51% from small cap publicly traded companies, and then another quarter were private companies, and that could be anybody from a family to maybe even a PE backed situation. And I know that Clay and Nick have alluded to some of the trends as it relates to private equity, but to follow on what they've said, we're seeing some similar numbers. The data that we're seeing as it relates to private equity being on the buy side had a substantial run up in 15, 16, 17, peaked in calendar 17, and then it's been a pretty rapid decline from 17 through calendar 23. And I don't have the exact math in front of me, but it's somewhere around 40, 50% per year, and that is deal count. So it's not aggregate, transaction value, but deal count has gone down substantially. And obviously, COVID was in the middle of all that. And so a lot of these private equity groups certainly had portfolio companies that they had been, financing for 6, 7, 8 years, maybe even longer in some cases. And so calendar 21, 22 saw quite a few of those PE groups, getting disposing of assets that had been in the portfolio for a period of time. So that's certainly a trend that we see continuing in 24. As Clay mentioned earlier, there's certainly private equity is still active, no question. You've got just a smaller number of groups that are in that industry, and I would say that they've got a smaller amount of capital within each PE shop. And to Clay's point, also, they may not be backing new platforms, but maybe providing existing management teams with additional capital, maybe in the same basin. Maybe they want to go into a different basin. We're seeing some of that activity as well. As Clay mentioned, we are absolutely seeing the family offices, I would say, trickle methodically into the upstream space and also midstream space, probably more so on the upstream side. It hasn't been quick. I'd say it's just been a steady trickle into 21 and then beyond. Of course, if you look at 20 and before that period of time, the other industries were very active. Everything in tech, telecom, et cetera, were much more active, and that's where a lot of the families wanted to participate. since that period of time, they've made their way into upstream energy. And so that's a theme that we continue to see play out in 24. One comment on that, I think that type of capital is going to be fairly long-term thinking. So our view is they should be able to weather, some of these storms that always do hit our industry, whether it's, volatility in commodity prices or geopolitical news or what have you. They do seem to have a long-term view. So look, I don't think it's going to take up the entire hole, if you will, of capital that was once in the space, whether from private equity or credit, but the families are starting to fill some of that gap.
Very good. And Chris, what's the main differentiator between your firm and your competitors in recent processes you participated in? And how can you stand out to sellers?
Yeah, I'd say the biggest difference for Sitio is just like we're just not very good at being the high bidder in an auction. So when you ask about processes, I always think of the auction processes, and of the 192 acquisitions our company has made, a small handful, meaning less than 10 of those acquisitions, have been true auction processes. So a lot more often than not, we are not successful. We look at all the auction processes. We'll look at the data. We're always curious to watch asset quality trends and see what the trends are in valuations that people are paying. But when in a true auction process, the likelihood is that we are not going to be successful. So to your question about why, so last year is a good example. So for the auction processes in which we participated last year that we were not successful in, we were off by a range of 20% to 100%. So that means somebody was paying 20% more or 100% more than we were. So when we do some post-mortem on that and say, okay, what would we have to believe to underwrite that and still maintain our underwriting discipline to get the rates of return that we need? You'd have to believe, if these are diversified packages across the Permian Basin, which some of them were, you'd have to believe the entire Permian Basin is going to get drilled in the next year and a half, or you're going to have to believe that it's going to be a more rational pace of development and oil prices are going to have to be $145 from today into perpetuity. Like, neither one of those is a thing that's going to happen. So that leads us back to what assumption are the competitors making to be successful in those transactions. And when we do these postmortems with the folks that are marketing the deals, it most times comes down to people's different assumptions about pace of development. So I think we're all pretty rational when it comes to commodity price assumptions. Most people working off the strip or some sort of internal price deck that may be a bit inside of the strip. And type curves rarely leads to a big difference in value, and maybe 5%, 10%, but not 20 to 100%. So really, to get to that magnitude of difference between where we are versus market clearing prices, it has to be a different assumption around pace of development. So people just assuming that operators are going to develop these assets a lot faster than what we're assuming. And so that's the biggest difference. Really, what we try to do is have a lot more success focusing on relationships. And so of the 192 acquisitions we've done, I said fewer than 10 of them have been true auction processes. Last year, we did fewer than 10 deals. One of those was an auction process. Really, the bulk of what we do is we form these relationships with folks, and it takes years. So one of the transactions we did in 2023 really started in earnest in 2019. So we fostered that relationship for 4 years. We made offers on all their assets. We made offers on half of their assets. We made offers for cash, offers for stock, and just over time, the relationship developed, and we were able to think about solutions together and solve what they were trying to solve for in 2023. That's where we have a lot more success. And we're patient, and we believe we'll be the ultimate home for a large majority of these minerals that are out there. It's just we have to maintain that discipline and patience.
Now let's switch gears to the financing market for A&D deals. Clay, given your firm's ability to evaluate transactions across the balance sheet, please talk about the challenges companies have seen trying to finance acquisitions in this market. Have you seen any unique structures arise in the last year, or are there any structures that you think will gain traction in the upcoming year to help get deals done?
Yeah, no, thanks, Jordan. I think in Crescent, we've had the benefit of, we took the business public, as I noted, at year-end 21, and we've had the ability to build access to capital. So I think last year we were just under 10% of the primary equity raised in the E&P space. We raised just under 10% of that, and we were right at 10% of the high yield capital raised in the E&P space last year. So we were able to kind of access what I'd call more traditional channels of capital last year to support our acquisition activity, which we're excited about, but certainly also focus across the market and see what others are doing. And to me, there's kind of three things that you've really seen that are interesting in the financing market. One is I think you've started to see a return post-COVID of the private credit market. It's harder to follow that in the private side, but you've certainly seen it even in some recent smaller cap public companies. So I think by our account, 4 or 5 deals over the last 1 or 2 years have been financing the publicly traded companies with private credit. And you've seen some new formation of firms focused on energy credit, certainly where yields are and spreads are, and have helped that. But you've seen that private credit market kind of come back to the space. And Nick brought it up earlier, but certainly this ABS structure, we've seen that and primarily in kind of more PDP weighted deals, as Nick mentioned, both on the non-op side and on the operated side. And you've kind of had some serial issuers of that paper, but that market has certainly continued to have a bid and seen some strength. And then I think given the amount of commodity volatility we've seen, you've seen both earnouts, kind of traditional earnouts, as well as kind of delayed financing on transactions. And so looking forward, I think you're going to see all three of those continue. I think certainly you'll see the private credit market continue to be active. Unclear how deep that capital is, but you will see it. I think the ABS train continues until someone makes a mistake. If someone makes a mistake, but I think for now that seems to be moving. And then I think in particular around gas, I think you could see a year where if you see deals getting done, you could see some earn-out type structures or opportunity for the seller to not feel like they left upside on the table.
Great. This next question is for everyone. Now, each of your companies has accessed the high-yield debt market over the last 12 months. Please talk about how you view that market given some of the turmoil across the rest of the energy debt financing landscape. Activity to increase if 2024 brings lower rates. Chris, can we start with you?
Sure. Our path to the high yield market was a little indirect. We looked at the high yield market for the first time in 2022 after we did some large cash acquisitions. And what we found is that we were getting questions from high yield investors as we did these investor education meetings about what is a royalty business, what is a royalty acre. So people that didn't even have any familiarity with the business model. And I don't fault them at all, really. If you look at the high yield market, it's very E&P centric. There was really at the time only one issuer from the mineral space in the high yield market, and that was Viper. And I think Viper was a big beneficiary of their relationship with Diamondback when they went out to the high yield market for the first time. And we just simply don't have a single operator relationship. We have over 240 operators on our acreage. So what we found is that we didn't want to be the one that taught that market and pay the price to teach that market with an issuance. And so instead what we did is, just like Clay was just alluding to, we went to the private market and raised some interim capital there. It was more expensive than we liked, but it had some prepayability function to it that we just wouldn't have gotten in the traditional high yield market. So we spent the next year trying to educate the high yield market. We went to high yield investor conferences. We went and saw the rating agencies multiple times. And gradually what we found over time is we got to the middle of 2023 and the questions were more about updates on our business, not what is your business. So at that point, we felt comfortable about leaning in and actually accessing the market. And it was a very warm reception. We priced our deal, we upsized it. And the pricing came in at 7 7/8. So for us, that was a positive outcome, certainly much more positive than what we were facing just a year earlier. So we found that the market got a lot better for minerals companies just as a result of the education process and a little bit of time going by and market healing. Now, just broadly on the market, the really interesting thing is as we've seen companies like PDC and Earthstone and Callan. We keep going on the list. Non-investment grade companies get acquired. The high yield market is just like any other market. It's a supply and demand market. And as the supply has dwindled, as you've seen high yield issuers get acquired, I think that does create some more appetite for those of us that are left. And we're seeing a similar dynamic in the bank market. When we did our first bank deal, it was a bit of an exercise to do it. And now we're seeing people calling us and saying, look, I've seen almost my entire E&P loan book disappear through M&A. Can we get into your credit facility? And we just weren't getting those inbound calls 2-3 years ago. So I think the M&A activity is benefiting those high yield issuers that are left in terms of better supply demand fundamentals. So it's been a good outcome for Sitio.
But
Yeah, I'd echo Chris' comments, and I think certainly when you look at the market today, it's spreads for E&P high yield are pretty close to lows, and so certainly seems like a supportive market. It actually seems like a function of what we're all talking about here, right? Is where's the use of proceeds? Generally, balance sheets for those that have access to that market are pretty healthy. People have issued high yield, and so there's not a big need for a cleansing. So I think it's going to be a question of, can people get deals done to access that market? But it certainly feels like the markets are supportive of people with access today.
Nick?
Yeah, I mean, I think for us and specifically, we have 2 high yield bonds. One we just issued this year, which was a bit of a hold your nose type situation, just given the rate environment, but given the M&A track we were on, no regrets. The other one we issued in 2 tranches, during a better rate environment, but our credit has steadily improved over that period of time. So, we're really probably at a leverage ratio, probably the lowest we've been over my tenure. We're really, relative to our credit rating, we're probably a full credit rating higher than we're rated. From a credit rating agency thing, it is. I'm sure Clay could tell you it's like pulling teeth to go in and go through the song and dance to get yourself upgraded. So we're probably due for that dog and pony show at some point, and that's a step we probably have to take. Our nearest term bonds are in 2028, and so they're getting closer to where you might start to consider accessing that market to, just to turn them out at some point in time. So in the next year to 2 years. And obviously as an acquisitive company, you can always kind of try to tie those 2 things together. So I think, to the extent that, both you have the potential for rates tightening, spreads are narrow, and the potentiality that we could be active in the M&A market, I would imagine that we'll be back at some point. And the fact that we're probably due for a credit upgrade at some point in the near future. You put those things together, which probably, means something bad will happen, honestly. Just obviously I'm saying that tongue in cheek, but it just, generally speaking, I think the high yield market has a funky way of being like this, which is that when credit spreads are this tight, if rates come down, does that mean necessarily things are bad and those credit spreads just widen out and rates wind up being the same? I'm not 100% sure. So we'll have to see.
Nick, let's stick with you for just a minute longer. Can you talk through how you've been able to partner with operators to get deals done in this financing market? And what are some of the benefits of this structure for both you and the operator? Do you anticipate more of that activity in 2024, given some of the growth in the non-op market?
Yeah, I mean, I think, off screen to my right is Evelyn and Fern, our Director of Investor Relations. And, one of the things we struggle about as we market our own company is just the uniqueness. We are really a unicorn. We are 100% an oil and gas company, but at the end of the day, we are a financial entity, right? 90% of the employees here never see an oil field. We all sit on one floor in an office building because we really move money from one place to another. And so we provide capital, and we own, our interest in the oil and gas properties. We are a real property owner. And so we are clearly an oil and gas company, and that is our technical expertise, but we don't have rig hands. We're not operators. And I think that's where I would tell you where our success has been, that for alternate forms of financing over the last 10 years, there have been everything from VPPs to private credit to all these bells and whistles that oil and gas companies have sought to find ways to seek external capital to provide them, capital to develop their properties. And most of them provide what I would describe misalignment, which would mean that no matter what happens, it turns out to be what's called a security, Jordan. And what that means is no matter what happens, the person who's giving you the money gets their money back, right? We are an oil and gas company, which means we understand taking risk. So ultimately, we are in many ways an equity owner, which means as a real property owner, as the partner in these properties, we take the same risk that they do. We underwrite. We have our own engineers who are doing our own technical work. And so that means our cost of capital theoretically is higher, but we're sharing the risk and the reward. And so as a partner, that has rung true because we are an oil and gas concern. And it means for an operator, all they have to do is send us a joint interest bill and a revenue check, and we can do the rest. Whereas the financial entities that they've been dealing with, frankly, no matter what happens, they win. And so that's great when everybody's winning, but when things get tough, it's been very challenging. In fact, one of our big acquisitions in the last year, which we don't have to go into the details around it, it really came down to they were in the 11th hour of a financing in which the people were demanding their money back, under any circumstances, even though the project was going swimmingly. They just wanted their money back. And so we came in and bought our interest in to provide those funding to return it. So, I think what I would tell you is we try to be a good and preferred partner. And I think, the testament to that is you get referrals and you get repeat business, right? And I think that that's something that we see. So I have, from an inbound perspective, I have a lot of optimism just based on what we've been spending our time on. That will continue to see business throughout 2024. I think that, this structure is becoming more and more necessary. There are assets sometimes that are just too big for people. There are assets sometimes where people simply don't, I would use our mascot project in Midland, Texas, in which, David could have sold the entire property for more money. He did not want to sell the whole thing. He wanted to operate and see it through. And by doing that, we wound up buying about 40% of it, and it provided him enough capital that he needed, but he wanted to stay in through the end of it. And so I think that we can provide customizable solutions, but ultimately we wind up being a partner that shares in those risks. And we generally know what we're doing. So when things go wrong, we nod and say, okay. We don't sit there and say, well, you have to give me extra money. I mean, with a VPP, which is a volumetric production payment, if your wells come up short, you give them more volumes, right? So that's the way it works. You wind up giving people, you just give up more of your well. And that's ultimately, that is what we would describe as a misalignment. So I think by being a good partner and having that reputation over time, it has brought us more business. But also by being a shrewd underwriter, we say no a lot. Right. So we tend to be pretty snobby about the assets that we picked, the partners that we picked. And it might not always seem obvious at first, but I think over time, our investors have come to appreciate that the assets that we bought have wound up performing pretty well over time. And thus that's, I think the proof has been in how our equity has performed over the last, over my tenure and certainly over the last 6 years.
Next, let's pull back for a bit of a global outlook. Brad, how strongly do you think oil and gas price shocks in 2024, either to the positive or negative, might affect access to capital over the next year for A&D transactions? There are obviously several ongoing geopolitical events that may cause some pricing volatility this year.
Thanks, Jordan. Look, I would just say that it's the magnitude of those shocks. I think to some degree, the industry is fairly used to news one way or another that, it's either positive news or or news that is surprising to the downside. And so, yeah, I think that it's just the magnitude of those shocks and the longevity of those shocks. What I mean by that is whatever news is coming out in any particular day or event, we're always trying to look at the fundamentals, global and U.S. supply and demand fundamentals. And I know, all of our industry and clients are doing the same. So I feel like a lot of the shocks in the news that may hit, hit on a daily or weekly basis, are in the rearview mirror to some degree pretty quickly. And again, people are really focused on, on the fundamentals of macro supply and demand. And so, obviously oil and gas are two different stories and have got two different drivers, supply demand drivers, if you will. But look, generally speaking, we think that if oil, is north of 60 to 65 and gas is, 250 plus or minus and above, it allows companies to plan and take comfort in their CapEx plans. And as a result, we think, M&A activity will continue in a positive way if we're north of those two price points.
Clay, how might certain price shocks impact your firm's activity levels? And then how do you adjust your underwriting methods during periods of volatility?
Yeah, I don't know what it says about maybe me or more our business, but when you say price shocks, I only think negative. So I'll start with the positive. If prices go up, I certainly think it's more fun to be in our business. But we would certainly be thoughtful and prudent around how we're investing capital if you saw a big move to the upside. I do think it's one of the benefits of being publicly traded and having a currency is the ability to kind of manage upward price shocks with relative value and not just absolute value. But to the negative side, I think we have a view on our side, and we say it a lot, is we want to have money when others don't. And so, a lot of that goes to how we risk manage the business. So as we sit here today, we've got, a hedge book that's built around our previously invested capital. So about 50% hedged in 24. We've got 25 hedges, which is rare in the industry. And we've also got a completely undrawn revolver. And so we've got a real ability to be aggressive in the event there was a negative price shock. And, I think, recent history would show in 2021, we priced our first high yield offering. We did the reverse merger that took the company public, and we did 6 other transactions over $100 million. So we did a lot of activity when in 21 when there was a lot of volatility to the downside or coming out of it. And so certainly, I think prudent risk taking is important. And so it's not, hey, prices are down, let's just go buy whatever we can, but trying to have capital and access to capital when there's negative moves in the commodity is an important piece of our business.
Now, finally, Brad, what are the biggest concerns that Stephens is hearing from A&D clients about the oil and gas market at this early stage of 2024? And what are you telling them?
Well, I think some of my answer is going to be repeat from what's previously been said. But look, anywhere you go up and down the capital stack, equity, debt, mezz financing, all of it to some degree it's challenging, and I think will, remain challenging. We've covered the geopolitical noise that obviously was pretty substantial in 23 carrying into 24, and everyone I think is mindful of that and how that's, impacting global supply and demand. So I think there's just a lot of things that are frankly carrying over from 23 into 24. And then we also, mentioned just the current administration and their mindset, towards their industry, towards our industry. So there's always something new on the horizon that the industry is going to, have to deal with. But look, I'd say from our standpoint, probably the number one concern, which isn't anything new, is just capital is challenged at this point in time. So I think it's probably going to get better. I think that at least our opinion is that we've got a good chance of credit being cheaper, going into 24 and 25, and that certainly helps things as well. But I'd say that's been the number one concern is just, there's good opportunities, good ideas out there. The question is how to best finance them.
Great. And what about the rest of you? Any closing thoughts? Chris, Clay, Nick, maybe in that order?
Sure. Yeah. So for us, the concerns are really twofold. One is related to our base business, the assets we own today. The other is related to acquisitions. So just on the base business, it's just a fact. The rig count was down by over 25% last year. So it's a dramatic slowdown in operator activity. Now, the remaining rigs are more efficient. They're drawing longer laterals. So it's not a one-to-one relationship between, production output from an equivalent number of wells today versus a year ago. But it is a slowdown in activity. So that does translate into to the results of the mineral owners. And as it relates to acquisitions, the biggest concern for 24 is whether it's going to look a lot like 23 in terms of the bid-ask spread between our underwriting and the market clearing prices. As I said, the failure of those auction processes that we saw in the third and fourth quarter of 2023 were very encouraging to us, and we like how we've entered 24. But it's always in the back of our mind of what's the competitive landscape going to look like. It's something that's out of our control, but we feel like if we maintain our discipline, the right time will come for us.
Yeah, happy to go next. I think for us, we'll have to kind of echo Chris, I think we think about the world similarly for our base business. We're spending a fair amount of development capital, so making sure we have great execution around the capital that we spend internally in our business and manage our base operations well. Both, from an operation and margin perspective, but also from a health and safety and environment perspective is always top of mind for us. And then on the acquisition side, I think it's certainly trying to bring creativity and unique ideas to a pretty choppy market and finding ways that we can kind of creatively put capital to work at a time where we're pretty excited to do so. We think there's lots of opportunity. So it's just going and figure out ways to make things happen.
Nick?
So I'm up. Yeah, I think we have three major projects going on all at the same time. So we have our Mascot project in Midland, which is a kind of in totality about a 90 well mega project, all going on. And then we have our Nova project going on with Permian Resources and our Forge project with Vital. And those are all relatively new, so it's a lot of logistical and organizational work on our end, and just managing those processes internally and keeping track and all that sort of stuff and budgeting accordingly. And I think, as I mentioned, I think when I look at the overall market, my concerns really are macro focused. I think the industry has been incredibly disciplined, as Chris pointed out. The rig count is down, and yet, I look at our Williston Basin. Williston volumes are growing, and Permian volumes are growing, and the industry's just become so efficient. Eagle Ford volumes are growing, even given its life cycle, and I think that these growth levels won't last forever. I think over the medium term, I remain very constructive on commodities. But in the interim, you have non-OPEC supply in general growing. Demand is not a problem. Demand is still growing worldwide. But you've had, pretty material growth in oil supply over the last year and a half, with a very, very accommodative OPEC. It is not a great backdrop. And geopolitical noise has very much helped so far. And so with the dearth of that, I am concerned. And really, the only thing that keeps me from being very bearish is that the cost structure is extremely high in the U.S. right now, right? We're still running costs very similar to when oil was $100. Now, that doesn't bother Chris because he's a minerals guy. He doesn't care about costs. It must be nice. But I do. I care. And so, we really are on the edge of a knife here. So I think the good news is I think about a $10 move in oil. You get into the mid 60s and parts of the Williston Basin simply don't work. Parts of the Eagle Ford don't work at all. And parts of the Permian, frankly, don't work at those prices at these cost levels. And so I think you could see a course correct pretty quickly in the U.S. if that was to happen. But I don't necessarily see the industry making those changes. And frankly, I've been making this comment about the natural gas market publicly to our investors for the better part of the year and being scoffed at, given the optimism around LNG. But I think, a lot of gas investors forget that, gas is fighting the fact that, a third of the supply in the United States is just a byproduct, right? And that, most of us are producing, the bulk of Northern oil and gas is 280 million a day that we're producing is not from our Marcellus properties, but a byproduct of the fields in which we produce it. And so ultimately, I think the overall backdrop this year is soft. I think over the next few years, it's going to catch up, and I think we're going to be in great shape. I think overall U.S. supply is maturing, but I think this year could be quite choppy. And I do think, if we have a bit of a sweaty period where it gets a bit ugly, it's going to create a lot of opportunities, especially the way Clay talked about it. I think it's the right way. We've been putting a lot of risk management. I think a lot of people, after a couple of years like this, where it's been relatively frothy, kind of forget about how bad it can be. And that's what I love about cyclical businesses, which is that, using the Buffett adage, you never know who's swimming naked until the tide goes out. And I think we, at NOG have been kind of prepping for this. So I think, we're kind of looking forward to seeing if it gets a little ugly here, particularly on our ground game business.
It'll definitely be an interesting year. Well, thank you, everyone. This was a highly informative conversation. Thank you again so much for sharing your thoughts. This concludes the 2024 Outlook for Upstream Acquisitions and Divestitures, a Stephens Investment Banking webinar panel in collaboration with Clay Rynd of Crescent Energy, Chris Conoscenti of Sitio Royalties, and Nick O'Grady of Northern Oil and Gas. Be sure to view the rest of this virtual thought leadership series. Thank you and have a great day.
Stephens, an independent financial services firm, has a long history in the energy markets and is highly regarded for its sector expertise and prudent client advice. Stephens has continued to affirm its industry focus, growing its dedicated energy investment banking team to 16 professionals and completing 219 transactions in the energy sector since 2009. The group's coverage includes exploration and production, midstream, oil field services, energy infrastructure, as well as clean energy. The combined knowledge of the energy team enables Stephens to provide clients an unmatched level of investment banking service, including mergers and acquisitions advisory, asset-level acquisitions and divestitures, fairness opinions, and public and private debt and equity offerings.